Welcome, everyone. We're so glad you're here. We have a wonderful presentation for you today with our partners at ExcelView. We have Jeff Jensen, and he's going to be giving us all his expertise today. We're so happy to have you, Jeff. Thank you. And I'm just going to go ahead and hand the reins over to Jeff.
Okay, well, thank you, Angela, and I'm very excited to be here with you on this webinar. So yes, I've been a tax accountant for over 25 years. I love the opportunity that I have to work with small business owners and help you navigate the accounting and tax world that a lot of people might not quite understand. And so I would love to help in your financial success. So to begin with, so we're a partner with ExcelView, which is, and coming up with this webinar. And ExcelView is a third-party marketplace for Icon Notes. ExcelView provides the back office solution, marketing, websites, funding, and more. And so we partnered with ExcelView to help with their accounting side of the accounting services. And like I said, my background is tax, and I've been doing that for a lot of years. And it can get to be a little overwhelming. So what we'll do is cover a lot of material. And at any time, if you have questions regarding the material that we're covering, just go ahead and type in your questions, and we will answer those. We'll have a Q&A at the end, but if something's pertinent to the slides that we're working on, we will just go ahead and answer those as we're going on as well. Yes, there is going to be a recording of this webinar, and it will be mailed out to you. So that's one of the questions that just came in. And so the slide and the webinar is going to be emailed out after the webinar is over. Okay, so, okay. So yes, you will be sending out that recording as well as the webinar. Okay, so let's go ahead and jump in to some of the frequently asked questions that we get. One of the many questions that we get is, how do I pay myself? Well, this depends on how your business is set up. And we're going to talk a little bit more about the different types of entities or business types later on. And so, but for right now, if you are an LLC or a sole proprietorship or a partnership, paying yourself is as easy as either writing yourself a check from the business bank account or making a transfer from the business bank account to your personal account. However you get the money out of your business account into your personal is how you can pay yourself. With corporations, it's a little bit different. You need to set up payroll and use a payroll provider so that they can take out the taxes just like as if you were an employee for the corporation. We'll get into that a little more detail later on, but for now, that's kind of the main part of how you pay yourself. Okay, so why is bookkeeping important? One, if we're keeping track of all of your transactions throughout the year, then it's easy to make sure that we're capturing everything that you're spending on your business. We see a lot of clients that come tax time, they're scrambling around trying to remember everything that they spent money for because it's not all in one location. And so what I would like to recommend to the clients is get your business checking account set up as soon as possible and make sure that you're running all of those expenses through that business checking account that you possibly can. And that way we're making sure that we're maximizing the deductions that you are that you can take and minimizing the taxes that you have to pay, making sure that we're capturing every deduction possible. This also, bookkeeping helps you make better informed decisions on your business because you'll know exactly where your business is throughout the year, and it helps ensure that you stay compliant with the IRS, and then it gives you a gauge of how the financially viable your business is doing. If cash is king in small businesses, and if your cash runs out, then your business is struggling. And so being able to keep an eye on your cash and make sure that you have enough to cover upcoming expenses is crucial. And one of those expenses is taxes. A lot of people forget about taxes because you don't have to pay for it throughout the year usually. You'd file it with your normal taxes at the end of the year with your 1040. And if you haven't saved for it because you haven't been taking money out like a W-2 takes money out every paycheck, then you could be caught with the inability to make your tax payment, or it could be a burden at that time. And so keeping up on your bookkeeping, keeping an idea of what your net income is for the business, then that will help you stay on top of things. A question came in about estimated tax payments. Yes, those are required if you owed money in the prior year. If you owed more than $1,000 in the prior year, the IRS wants you to make quarterly estimated tax payments so that you stay on top of that, because they would, if your business stayed the same as the prior year, they want you to pay enough throughout the year so that by the end of the year you've paid in what you're due and it's a wash, it's a break even. And so they take that, what amount that was owed, divide it by 4, and those are your 4 estimated quarterly payments for the next year. And obviously doing all of this will help eliminate stress during tax time because you won't have to struggle trying to make sure that you're capturing all of those deductions. So that's why bookkeeping is important. Another big question that we get is, what can I write off? Well, the IRS leaves it wide open, and because there are so many different businesses and so many different scenarios in those businesses of what can be a write-off. So what the IRS says, as long as it's ordinary and necessary for your business, then it's a business deduction. Well, what does ordinary and necessary mean? That seems really vague. And it is very vague, but let me give you an example. So if a contractor that builds homes goes to Home Depot and they buy a saw and a nail gun so that it helps them continue to build homes, that is ordinary and necessary for that contractor. But if I, Jeff Jensen, go to Home Depot and I buy that exact same saw and that exact same nail gun just because I want one of those, that is not ordinary and necessary for me as an accountant. And so that is not a business deduction for me. So hopefully that clarifies what is ordinary and necessary. Some of the other common write-offs are cell phone, business travel, marketing and advertising, home office, vehicles, continuing education, professional membership fees, bank and credit card fees, books and therapeutic aids, websites and software, meals. This is a small list and it's definitely not all inclusive. But this is a general idea of what can be deducted. Couple questions came in. Can we write off losses for no-shows for our clients? So that's a good point, and I'll bring in, so as small business owners, we prepare your taxes on what's called a cash basis. So there's two types of methods to do accounting. There's cash and there's accrual. Accrual is mainly used for large businesses that are publicly traded. That's where you have receivables and payables. The problem with accrual accounting is you're paying, you're recognizing income when you invoice a client, and you are recognizing the expense when you receive the bill. So not necessarily when it's paid. Cash basis is exactly that. When you receive cash from your client, you recognize the income, and when you pay out the expense, you are recognizing the expense. And so it follows your checking account. And so coming back to that question, can we write off losses for no-shows for clients? Unfortunately, no, because they never paid you. And so you never had to recognize that as income to begin with. Another question came in, advertisement on your car. Now your car can definitely be a write-off, but just by putting a sign on it does not count it as counting it as a business purpose. And we'll get more into car deductions in a little bit later in the presentation. When you say meals, does this mean breakfast, lunch in general, or does it mean have to be a meeting? So with meals, and we have another slide for this as well, it has to have a business purpose. So you're either meeting with a client, you're meeting with an employee or a vendor or something that's going to help your business grow or keep your business running. There has to be some kind of business purpose. Where would CEE training be placed as a write-off? That would fall under continuing education, and it definitely would be a write-off. And we'll get in a little more into that with business travel. It doesn't necessarily mean that you have to, stay where you're located and do CPE courses online. You could travel to a seminar or a different location, and then now you have a business purpose for that travel. And so you'll be able to deduct that as well. Okay. What about clawbacks? So if you were paid originally for work that you performed for a client, and then for some reason that money was clawed back, I think this is what you're referring to, then yes, that would be a deduction at that point at time, because it's coming out of your checking account or it's deducting from your other income that you have. So yes, clawbacks are a deduction. And then attorney, yes, would fall under legal and professional. And so, yes, if you're paying for an attorney, that would also be a write-off for your business. Okay, yes. Okay, so that And I'm sure more questions are going to be popping up as we go along, but that is kind of a general list of business write-offs. Now, a lot of these, you're just paying for them right out of your business checking account or putting them on a credit card. It is easy to count those as a business or count those as an expense. But there are some that you might not be paying for them out of the business checking account, but because you're paying for them personally, but they are a business write-off. And so just to touch on that a little bit, like your cell phone, you are conducting business on your phone, either calling clients or calling vendors or whatever the case may be. Your phone can be a 100% business deduction. Now, if you're on a family plan, we can't deduct the rest of your family, but we can definitely deduct your portion of that. The other thing is home office, and we'll get into this a little bit later as well in more detail, but you're paying for things at your home, we can deduct your home office as well. The other thing that falls under this category is vehicles. So you're driving around doing that. Again, that creates the business purpose and we can deduct that. So I think we're good. Okay. All right. So another thing that you can write off is, if you're paying for the subscriptions for Vide or Iconotes, those are ordinary and necessary business expenses that will count as write-offs for you. Okay, so let's talk a little bit more about home office deductions. So it has to be used regularly and exclusively for business. But what that means is you have a room that's dedicated for your office. And there's two ways of calculating that. There's the simple method or the standard method. The simple method is you take that room and you measure the square footage of that room. So say it's a 10 by 10 room. So it's 100 square feet. Then you multiply that by $5 and you get a $500 deduction for the year. And then the standard deduction is similar, but it just gets a little more complicated. All you do is you still measure the square footage of that room, but you divide it by the total square footage of your home. And then that percentage you get to deduct of your rent, mortgage, home insurance, any house repairs, anything that goes along with your home. Now, say for instance, you have a direct cost that's in your office, you decide to put in some cabinets so that you have extra file storage space. Well, because that's directly associated with your office, that is 100% write-off. You don't have to take the percentage of that. Internet for home office, yes, definitely, that's a deduction as well. Now, as a note, just because you have your home office, if you had an office away from home that, say, you meet with clients and you're paying rent for that, you still can deduct the home office as well because you can do administrative work from your home office. For instance, if you're reviewing client notes or just reviewing your income statement or balance sheet or whatever the case may be, that administrative work done at your home counts it as a home office and you get that deduction. Okay, so now let's talk about vehicles. And this kind of comes into what the question was earlier about, can I write off the vehicle by just putting a decal on the car. Well, just by putting the decal on your car doesn't necessarily establish the business purpose, but obviously it can help, stir up new business by drawing attention to your business, your practice. So the car deductions, it's based on what business use percentage you are using it. So you'd keep an auto log tracking the business miles. Say you're driving to a client, or you're driving to the airport because you're going on some business travel, or you're driving to the post office to get something mailed off for business, or going to the office supply store. Any of those things establishes your business purpose, and you can count the driving to and from those locations. So a question just came in about, there are two areas in TurboTax to input vehicle expenses. Is there advantages one over the other? Honestly, I have never used TurboTax because I've always used professional software. So I'm not sure what those two are referring to. We recommend that you just keep track of your auto miles, because even if you're using, so they're coming back to the car, there are two methods with your auto deductions. There's either the actual expenses, or there's the standard rate, which means you take the standard rate is you take the miles that your business miles that you're driving times the standard rate that the IRS offers that year. And it's roughly around 55 cents per mile. And so that takes in account for all the things associated with your car. And it makes it very simple. The actual expenses, what you would do is have the expense of the car, so the purchase price, plus all the expenses that go along with it, your oil changes, gas, insurance, tires, maintenance, whatever it is, and you add all those up together, and then take the business percentage that you've calculated, the business miles divided by the total miles driven, and that percentage of those items you would be able to write off each year. Okay, another question just came in. One under business, one under... this is referring to the TurboTax. So I guess there's a place to enter it under your business, other under your personal. Again, not familiar with TurboTax, so I'm assuming you would just enter in your business miles under the business side. Another question, how do you write off your collaborating physician? So I'm assuming you're paying another physician to do some work with you. When you're writing, making a payment to them, either sending a check or doing a wire transfer, that is going to count the expense. But what you would want to do is have them fill out a W-4 form, because any payments that are for over $600 per person per year, you will need to issue a 1099 at the end of the year. And so, yes, that would you would be able to write off the collaborating physician. How about driving to a PO box office? Yes, if you have a PO box and you're going to collect your mail, then yes, that is that counts as a business mile for you. If you drive for about an hour for work, can you write off that miles? Yes, as long as there's a business purpose, you can count those miles as business. Okay. Okay, so let's talk a little bit about business travel. And you'll probably see the theme of this, but it comes down to having a business purpose. Um, so as long as you're traveling there for whatever reason, say you're going to a seminar for CPE credits, or it's just another reason for your business, that counts as your business travel. Now, that doesn't mean that you can't do anything, any personal fun activities while you were there. For example, if you had a business purpose on Friday and you had a business purpose on Monday, you still get to write off the whole trip, even though there's some personal activities that you did during the Saturday and Sundays. It also means that you can take a spouse or partner along with you on that business travel, but you just wouldn't be able to write off any excessive costs like souvenirs, or say you went to Disneyland and so the park tickets, those would not be able to be a write-off. But anything business related can be a write-off. And so convention, seminars, meeting with clients or vendors, or conducting business research, all of those are business ideas that give business purpose to your travel, and can write those off and definitely take advantage of those, because it's a way that you are able to get the write-off, but yet still have some fun with your partner or spouse. Okay, so now we're going to talk a little bit about entities. And there are 5 main types of entities. So sole proprietorship, that is one of the easiest and most common because there's nothing to do to get it established. It's automatically, if you just say you're in business, you are a sole proprietorship. It just goes off of your social security number, and it's just another schedule on your individual 1040 tax return. General partnerships are kind of the same as a sole proprietorship. It doesn't take anything to any filing requirement to get them started. Just by you agreeing to be a partner with another individual, you have established the business partnership. The only thing that it does require that you file and get an EIN with the IRS, and that's because a partnership is what's called a pass-through entity, which means it has to file its own tax return, but it never will pay taxes by itself. That tax return is more of an information return that tells the government this business had this much in income, this much in expenses, and so this is its net income. And these 2 individuals are the partners of this business, and this is how they are dividing up that net income. And so now watch for it on their individual tax returns and make sure they're reporting that on their 1040s. That's all the whole purpose of the business partnership tax return. And then each of those individuals would receive, it's called a Schedule K1, and that would report their income or loss from that partnership, and they would record that on their 1040 tax return. Sorry, just make sure that couple questions. Do home office car write-offs differ depending if you are an LLC or an S corporation? They vary a little bit, but for the most part, it's the same. And so an S corp, you just have to have kind of a reimbursable plan to where you're still taking the same deductions. You're just having the corporation, the S corp, give you a reimbursement check for that. An LLC, and we'll talk a little bit more about LLCs. I'm going to skip over them and jump to the S corp and the C corp, but LLCs are pretty much the same. And so, and then the next question, can you go from a S corp to a C corp or vice versa? So you can, but there's more advantage from going from a C corp to an S corp. But once you've made that election, you usually don't switch back and forth. You make that election and you stay with it. So we want to make sure that you understand the ramifications of all these entities so that you make the right decision to begin with and stick with it. Okay, so coming back, there's another question that just came in. I saw in the handouts that driving to and from office does not count. That's when it's considered commuting. But if you have, say, an outside office and you do work from your home as well, that is not considered commuting at that point. You're driving from one business location to another business location. And so then it could be counted. Okay, so let me go ahead. I'm going to come back to these two questions because I think I'll cover them as I go through. So I kind of finished explaining what a partnership is and how it's taxed, that it files its own tax return and then it flows into the individual owners through a Schedule K-1, and they report that on their 1040 tax returns. An S corporation, well, I'm going to jump to a C corp. A C corporation is its own entity. It files its own tax return and it has to pay its own taxes. And so it's not any relation to the individual owners. A C corporation is usually for bigger corporations like IBM, Microsoft, all of those publicly traded corporations are C corporations because they have unlimited number of shareholders. Well, and a C corporation is usually not beneficial for small business owners, and the reason is the C corp will pay taxes itself. So whatever its net income is, it'll pay 21% of what that net income is for taxes. And then if it issues a dividend to the owners, that dividend is then counted as income to the individual. And that individual would have to recognize that as income as well. And so then you get into some double taxation with the C corporation. So that's why it's not very beneficial to small business owners. An S corporation is a corporation, but it functions more like a partnership. It's another pass-through entity. You have to file its own tax return, but the S corp will never pay taxes in and of itself. It's more of an information return. The partners receive, well, I'm going to come back to this. Oh, so we can leave it here. So the S corp will send a K-1 to the individual owners, and they will report the income or losses on their individual tax return. It's a pass-through entity. There are some advantages to an S corporation. So A sole proprietorship or a partnership are subject to self-employment tax. And what self-employment tax is, when you work for somebody as an employee, they take out of your paycheck Social Security and Medicare taxes. And the Social Security is 6.2%, the Medicare is 1.45%. That adds up to 7.65% that they're deducting from your gross wages. Well, that employer also matches your same 7.65%. So they're paying into the government a total of 15.3%. Well, when you are a sole proprietorship or a partnership and you're subject to that self-employment tax, you are paying that 15.3% on your net income. That's what self-employment tax is the Social Security and Medicare portions on your net income. Well, an S corporation is not subject to self-employment tax. But the reason that they're not subject to self-employment tax is the S corp the owners of an S corp have to pay themselves a reasonable wage. What is reasonable? It kind of depends on your industry as well as how well your business is doing. But the key is you want to keep that wage high enough that it meets the requirement for the IRS as a reasonable wage, yet low enough that you're minimizing that 15.3% that you have to pay, because it's the same as the self-employment tax. And so you want to keep it low enough that you're still getting that tax savings. And then the other portion of your net income, you just pay out as an owner distribution, and that portion is not subject to the self-employment tax. So that's one of the advantages of an S corporation. So let me come back to an LLC. And why I skipped an LLC is they're fairly new in our, I'm not exactly sure when they came out, but they definitely haven't been around as long as a corporation or a partnership or a sole proprietorship. And when they first came out, the IRS didn't know how they should be taxed. And so what they decided, that if you are a single member LLC, meaning there's only one person that's the owner of that LLC, then they will be taxed as a sole proprietorship, meaning you will file a Schedule C on your 1040 tax return. If you are a multi-member LLC having more than one partner in the LLC, you'll be taxed as a partnership and have to file a partnership tax return, and each partner would receive their Schedule K1, and that income would flow to their individual tax returns. But they also give the LLCs also have the opportunity that you can elect to be taxed as a corporation, or more specifically an S corporation. So LLCs give you a lot of flexibility in that you can be taxed like the other entities. So some questions. Oh, okay. Okay, so to boil this down, yes, your entity structure does matter, how your business is taxed, and how that reflects on you personally. And for the most part, especially if you're a sole proprietorship, partnership, LLC, or S corporation, all of those just flow through to you personally, and you'll have to report those on your individual tax returns. So don't just, because you're in business, don't just run out and file your personal tax return without considering the tax consequences of your business. And we're definitely here to help you in any way that we possibly can. You can schedule an appointment with one of our tax professionals, and we can walk you through these different scenarios and make sure that you're choosing the best scenario for your needs. Okay, so we talked a little bit about an S corporation, and you just have to elect to become an S corporation. So whether you start out as a C corp, you'd make the election to become an S corp, or if you're an LLC, you can make that election. We recommend that you schedule an appointment with one of our tax professionals, walk through, make sure that you understand the requirements for that reasonable wage, and even talk through what you think that reasonable wage should be, because it can be based on what you would be paying somebody else to be doing the same type of work you're doing. And so there's a lot of things that can go into that. But to summarize, we want to keep that wage high enough that it meets the reasonable wage requirement by the IRS, yet low enough so you're still maximizing your tax savings from that self-employment tax. Okay, so another thing that we wanted to cover, the Department of Revenue, or the U.S. Department of Revenue, has come up with a new requirement from their Financial Crimes Division. And the reason for that, they're trying to get a handle on money laundering and tracking that down. And so they are making this requirement that all businesses file a beneficial ownership interest report. And this report is a one-time report that goes out, or one time that you have to file it unless there are updates to the report. So if you change your address or change who is the ownership of the business, or you hire a new employee that is a decision maker in your business, all of those changes change this report and you'd have to update it. But who is required to file a BOI report? Anybody or any business that is registered with a state agency. For example, LLCs or corporations fall under this category. If you're a sole proprietorship and a general partnership that haven't registered, then you are not required to file this BOI. So the filing requirements are, so this is just a new rule, and it just started in January of 2024. And so any business that was created prior to January 1, 2024, they have the whole calendar year of 2024 to file this report. If your business was created in 2024, then you have to file this report within 90 days of the state acknowledging that your business is active. And then after 2024, so starting in 2025, you will have 30 days from the time that this is, that your state agency says that your report is active. Coming back, looked like we had a question about, the taxing entities. It says, so does single member LLC pay self-employment tax? It does, but the LLC doesn't pay it. Because it's included on your personal tax return, on your 1040, you would pay that self-employment tax on your 1040 tax return. Okay. So if an LLC with one member owner is considered a sole proprietorship, then you are required to file a BOIR. Yes, you are required because you have filed with the state agency. And so then, because that LLC was filed, even though you're considered taxed as a sole proprietorship, you still need to file that report. And we're dropping a link in. We can help you with filing that BOIR report into the chat right now. It actually, so it does a state registration of a fictitious name or a DBA require the new report? It requires you to update your report to add that DBA. So once it's filed, if you make a change like that, then you have to go back and update that report once it's filed. And yes, it is only filed once. So once it's filed, then it's taken care of unless there are updates to that report. Okay, so just to go over some of our the plans, what's included with our subscription, you would have access to our dash, the financial reports, tax planning sessions, monthly payment with no contract. You'd get monthly bookkeeping. You'd get your personal and business tax return filed. You'd have a dedicated bookkeeper, a dedicated accountant, and we'd help make sure that you're compliant with the IRS. So VIDE, just to give you a background on us, we have been serving more than 10,000 small business owners. On average, we save our clients 50 hours per year and a cost savings of $2,500 each year for each client. We've had 0 clients audited by the IRS in the past 7 years. Here's a comparison of our services compared to our competitors. We offer more, we match or offer more services than they do for low cost with higher quality. So that's a little bit about us. You can see and compare us to them. Here is a QR code or a website that you can go to, or a 800 number. We're going to drop the website into our chat so that these are different ways that you can schedule appointments with us and get started with us. iConnotes users can try us for $500 off 2023 taxes and 1 month free. So these are different ways that you can schedule that. So I think, I think that's the end. So I've tried to answer your questions throughout the webinar, but if I miss some or if you have additional questions, go ahead and throw those in and I will answer those now as we continue. Can you rent the home office to your business instead of taking the standard deduction? So you wouldn't want to rent your home office because then you would have to count the income that's coming. And so what you'd want to do is just count the expenses that go along with it instead. So that's, yes, that's how you would handle that. Can you deduct moving expenses to move from one office to another and the decorating costs? Yes, that is a business expense. So if you have to hire somebody to help move your business office, or if you are just renting a truck to move it, all of those costs can be a business write-off. Can my LLC pay my medical insurance? Is it tax deductible? So this, with health insurance, it gets a little complicated because it's based on because different entities write off medical a little differently. For the most part, I would say yes. You just have to jump through some hoops to be able to do it as an S corporation. Does LLC also, I think I answered this one already, but I'll go ahead and do it again. Does LLC also pay self-employment tax? So the LLC never pays taxes in and of itself, but because the LLC is filed with the individual on their 1040, that's where they would pay that self-employment tax on their individual tax return. Do you have a subscription to Iconotes in order to sign up for? No, you do not have to have an Iconote subscription to sign up for Vide services. Okay. Include a CEU. I'm not sure what. So one question came in, does this webinar include a CEU? I'm not sure exactly what a CEU is, so maybe type in a clarifying question. Is that continuing education? Okay, if that's, no, unfortunately, we are not a continuing education partner, meaning, so we don't qualify as you getting credit for CE, continuing education. So sorry about that. How do we handle our pro bono client sessions? So because coming back to the discussion of that you are a cash basis, you're only recognizing income when you receive the cash, and you're recognizing the expense as you pay for that expense. If you met with a client and they didn't pay you, then you just never recognize that as income. So that's how that would be treated. I'm new and haven't kept track of anything. What do I do? Probably the easiest, hopefully you have a business checking account set up. The easiest thing would be to sign up for our services and help us, or let us help you get those transactions up to date and get your everything current. By having them into the business checking account, we'd be able to do all the accounting for you and get you up to speed. Can you complete an online self-paced training course but travel to a hotel to do that? So write off a potential as the travel as a business. I guess you could, as long as there's a business purpose, like you needed to get away so that you could focus on that course. It kind of becomes a little bit of a stretch where it's not right in your, you could do that course anywhere. You could do it from home, but as long as you could justify or come up with that business purpose, then yes, you can write that off. Can you write off payments into a Roth IRA? A Roth IRA is non-deductible going in because it grows tax-free, and then it's non-deductible coming out. So a Roth IRA is not a deduction, but you can get a deduction if you're putting away for retirement other ways. What does the bookkeeping service offer you entail? So it's the monthly bookkeeping, getting your businesses bookkeeping caught up, as well as you'd have a dedicated accountant and a dedicated tax professional to answer your questions, answer tax advice, tax planning, and help you make sure that you're on track so that you don't have surprises once tax time comes around. Can the LLC help with student loans? Unfortunately, that is not a business expense, even though you probably had those student loans so that you could get into this business. But that's not a write-off for the business. continuing education is, because it's upkeep of your training, but not the education prior to that. Clarifying question, can office decorations be counted as a deduction? Yes, absolutely. If I file a business return, do I still need to file with my husband? So this comes back to, it depends on how your business is set up. If it's a single member LLC, then it will just be included on your personal 1040, which you're filing jointly with your husband. If it's, say, an S corporation, then it would flow into you personally, and you would recognize that K1 from the business income on your 1040, which would also include your husband, the married filing jointly tax return. So yes, it would affect your individual 1040 tax return. Please touch on how the service sends auto reminders on estimated taxes and next step actions, proactive partner for practices. So you'd have scheduled phone calls with your tax accountant that would get those estimated tax payments set up. And then on a regular basis, you'd be talking with that tax accountant to go over and make sure that you're covering your tax, those estimated payments, as well as doing tax planning for the next year to make sure that no adjustments need to be made to those estimated tax payments. If I'm a sole proprietor and have done everything on my Social Security number, I still file jointly with my husband? Yes, absolutely. Because that's just how you're filed individually. It would just be another schedule on your 1040 tax return, a Schedule C. Okay, I think that was our last question. Thank you everyone for joining. Hope this webinar was a help to you. Look forward to meeting with you again. We will be sending out these slides and a recording of this webinar to all of you that attended, and glad to help you, and hopefully we can do this again sometime. Thank you.